Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome Tim Koller. Thank you, Tim, for joining me on our Fortuna Advisors podcast, Create More Value.
Thanks, Greg. Glad to be here.
Tim is a core leader of the strategy and corporate finance practice at McKinsey Company, which is perhaps the top strategy consulting firm globally. Tim has served clients on value creation, corporate strategy, capital markets issues, and M&A transactions. He founded McKinsey's Strategy Corporate Finance Insights team, the firm's hub for financial and capital market analysis and valuation. He also leads corporate finance and capital markets research, including the development and maintenance of McKinsey's corporate performance database. Tim is the lead author of Valuation, Measuring and Managing the Value of Companies, which is right over here over my shoulder, which is the book, by the way, that attracted me to our field over 30 years ago. McKinsey was working with my company, the Grumman Corporation, and when I moved from engineering to business analysis, my boss, John Ballo, gave me a copy of the book and asked me to read it and prepare a presentation book report to teach everybody the principles. I was hooked. This book, now in its 8th edition, has sold more than 1 million copies, and it's even used as a textbook at top business schools. It is still the best book in our field, although there have been many written since then, including my own. Tim is also the lead author of Value, the 4 Cornerstones of Corporate Finance, which aims to explain the linkages between strategic decisions and value creation. Before joining McKinsey, Tim was a vice president at Stern Stewart, though he left for McKinsey before I joined Stern Stewart. He also lectured at business schools such as the University of Chicago, Northwestern, Tuck, Yale, and INSEAD. Tim, you shared with me the progress the business community has made on many fronts, but that there's still more work to be done on getting a true long-term value perspective, especially in large, complex companies. Can you share your thoughts on this?
Yes, thank you, Greg. What we've observed, well, the fundamental ideas behind value creation are one, that value is driven by growth and return on capital, and that you also need to have a long-term perspective about how do you achieve growth and long-term and return on capital. So I think we've come a long ways over the last 35 years or so, where companies were focused primarily on accounting earnings to focus more on return on capital and cash flow, et cetera. However, I do think that there is still a ways to go, particularly for larger companies on the revenue growth side, particularly organic revenue growth. I see too many companies that get caught up in, well, I set an earnings target either internally or there's a consensus, and I want to meet that. And the easiest way to meet that is to cut back on product development or building distribution capabilities or other things that are more long-term oriented. So we do still see companies that are too focused on the short term. We also see companies that are sometimes still focused on accounting things or gimmicks, like, can I do some short-term share repurchases to boost my share price, et cetera. So there still is that bias towards the short term that doesn't afflict all companies, but many companies, that gets in the way of really making the shift, if you will, to allocating resources to where the growth opportunities are, and really taking advantage of that.
Yeah, I couldn't agree more. My book is called Curing Corporate Short-Termism, so obviously that's a hot button for me, but that was well put. So what does a CEO need to do to be a good strategist? And how important is it that they excel at this one skill?
Well, I think that the CEO has to be a good strategist because they're the ones making the important strategic decisions ultimately, right? So you have to have that skill. You can't just be a leader of people, right? Without the ability to make the tough decisions about where to invest, where not to invest, where to put people, et cetera. So it's an absolutely essential skill. And It also, I think more CEOs need to be a little bit more granular in their strategic decision making, in the sense that if I have, 3 divisions and each division has 20 business units, I can't just think about strategy at the 3 division level. I have to think about it at the 60 business unit uh, level, 3
Mhm.
times 20. And so that, because each of those 60 units is going to have different economics, different priorities. So I think
Mhm.
it's not just being a strategist, it is also making tough decisions about, okay, I'm not going to put as many resources into this business, a slower growing legacy business, even though it's been an important business and it's a big business, but I've got some growth opportunities and I need to shift the resources. They're the only
Mhm.
ones who can make that tough call, and the CEOs. And so if CEOs aren't prepared to do that, they're not going to succeed over the longer term. They'll just, and so the worst thing is when you get a situation where a CEO will simply say everybody's got to cut costs or
Mhm.
everybody's got to grow revenues. Well, that may not be the right thing when you have a complex set of
Mhm.
businesses that you're managing.
Yeah. 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 I've seen that many times where there's a smaller, fast-growing business, and they get the same cost cutting pushed on them that the sort of older, more
Exactly.
mature business gets, and it winds up stifling the growth in the
Yeah.
future.
I
Uh,
remember one company I came across where there was a corporate wide push for inventory management. And one of the
mhm.
businesses was a service company that didn't really have any inventories, right? But they still had to do all the paperwork and
Mhm.
all the reporting that every other unit had to do, even though it was totally irrelevant to their business. And so we see too many management sort of edicts, if you will, where everybody's expected to do the same thing,
Mhm.
and it just doesn't make sense.
Yeah. Yeah. That's a good example. So the sort of next order of business, and you kind of touched on this a little bit, is resource allocation, as you mentioned, is critical. And I'm surprised at how many companies we walk into, and we assess the value creation in different business units, and we look at the investment rates in each of the businesses and how poorly those two things are aligned. Very often,
Mhm.
they're investing too much in the businesses that aren't creating any new value, and not enough in the businesses that that really are. So with it being so important, how can management teams get better at it? What do you think are the biggest obstacles that stand in the way of people being really good at resource allocation?
I think the biggest obstacles are, I think there's a number of things companies have to do. Let's say, and that they'll explain what the obstacles are. First of all, a lot of companies don't have very good data at a
Hmm.
granular level. We often find that when we work with a client that we have to spend the first 3 or 4 weeks getting data about, you know, 20 or 40 business units that everyone agrees upon in terms of,
Hmm.
what's the growth potential, how fast is the market growing, what's the historical return on capital, what are the competitive pressures, et cetera. So
Hmm.
getting better data and presenting it in a way that everyone can see sort of who's creating value, who's not, where the potential is, where it isn't. Right? Then
Hmm.
you have to overcome a lot of biases that are built into the way organizations
Hmm.
work, right? One of the biggest ones is inertia, right? Where, companies, it's easier to shift things 5 or 10% from one year to the next than to make big changes.
Hmm.
So you have to overcome that. And the only way to overcome that, we have found, is for, once again, the CEO and CFO, or maybe a couple of other top executives, to make
Hmm.
those tough decisions. They have to overcome the desire for stability, for smooth earnings, to sort of say, no, we are going to shift those resources, right,
Hmm.
from one place to another. And one of the big barriers, for example, is trying to achieve consensus, right? If you've got a team of top management team of 10 people and you try to achieve consensus, you're just going to water things down, right?
Hmm.
It's good to have a big team to have debate so that the decision makers have as much information as possible. But trying to achieve consensus never works, right? You need to
Hmm.
have a small group, maybe the CEO, CFO, maybe one or two others who have an enterprise wide perspective, make the tough decisions, go back then to the larger team, say, here are the decisions that we made about resource allocation and why, right?
Hmm.
Because that's the only way you're going to overcome the fact that there's a power imbalance. Oftentimes, The bigger businesses are the ones that are legacy, that are growing slower, but they have more political power inside the
Mhm.
company because they're
Yeah.
bigger, right? But they don't really warrant those resources, right? You also have to have a set of rules that you follow. And I learned this from Daniel Kahneman, the Nobel Prize winner who sort of invented the field of behavioral economics, if you will.
Mhm.
He told me once that the advantage that organizations have over individuals is that they can put in place rules and processes, right? And you need to have it so that once again, it's the CEO has to say the rules are the rules. You don't, the division head who plays golf with the CEO should not be allowed, or should not be, the CEO's got to say, no, I'm not going to, just because you're my friend, I'm not going to give you your pet project, right? It's got to go through the process, right?
Mhm.
Everything
Mhm.
has got to go through the process, and the CEO has to reinforce that. So there's a lot of work to be done by the CEO or the CEO's delegate, who's somebody who's really going to be influential, can really make decisions, and the CEO is not going to reverse them. Someone like the CFO or a COO if they have it. But you
Mhm.
really need to have strict processes, rules, strict analytics, tough decision making by the top decision makers. That's what you need to do to overcome the resource allocation issues. And the other thing you need to do is you need to make sure explicitly that all the strategic initiatives that you've prioritized are funded, right, in the
Mhm.
budget, right?
Right.
Oftentimes people oh, we're going to do all these great things, and then when the budget time comes around, they're not in the budget, right?
Mhm.
We did a survey and we found that only about 30% of executives believed that the strategic initiatives were fully baked into their budgets.
Wow. That's not good.
No.
uh, are there any other biases that you've seen that you want to
Well, the
talk
other
about?
biases are there's a couple other biases. Inertia is one of the big biases,
Mhm.
as I
Mhm.
mentioned. Another bias is groupthink, or a variation on that is sunflower management. The unique characteristic of sunflowers is that they always face the sun, right, as the day goes on. And a lot of corporations, people, instead of saying what they really believe is the right answer, they try to sort of figure out, well, what does the most senior person want to hear, and
Mhm.
they mimic that, right?
Mhm. Yeah.
Once again, that's a product of an organizational culture that is not healthy, right? Or
Mhm.
groupthink, where you've got 7 or 8 people in a room, and the direct conversation is going in a certain direction, and you're afraid to speak up because you think you're the only one, right? And so you need
Yep.
to use techniques sometimes to overcome those. You need to use techniques, maybe assign a devil's advocate, maybe
Mhm.
you do some kind of secret ballot before the debate,
Mhm.
so you get a sense of where people are leaning, and know whether other people are leaning in the same direction you might be leaning. That's it.
Mhm.
That's so groupthink and sunflower management. The other one is that's a big one, is confirmation bias.
Yeah.
Right? We're always looking for data that confirms our hypothesis. Scientific method says you should be looking for data that disconfirms your hypothesis. Now,
Mhm.
ideally in the business world, you're looking for both, right?
Mhm.
And there are some easy techniques. One is we call it a premortem. Force
Mhm.
yourself to think about all the things that can go wrong and what you would do in those circumstances, right? Too many
Mhm.
companies don't do that. Scenario analysis is helpful, but not plus or minus 10%. Really think about what the upside is, what the downside is. Too many companies, if you set a hurdle rate of 12% for your projects, everything comes in at 14% kind of thing. People
Mhm.
sort of structure it to make that. The reality of it is you should have a scenario where you actually lose money, a scenario where it's much bigger for many projects, not necessarily for a maintenance project, but for many new initiatives, the range of scenarios should be larger. So those are
Mhm.
some of the key biases that affect companies,
Mhm.
and some of the techniques you need to use to try to overcome them.
Mhm. It's all really good. I just want to tell one little story about one little part of what you said. You talked about secret votes. Years ago, I became troubled by recruiting processes, starting when I was president of North America for Stern Stewart, but also when I was group head at Credit Suisse. I felt like the conversation would evolve toward whoever I wanted to hire, everybody wanted to hire. And so ever since we founded Fortuna 16 years ago, whenever we're hiring somebody, we always, after like maybe 5 people interview the person or 4 or however many we have, they all have to submit a secret vote of whether they endorse the person for hiring or veto them, or there are a couple other categories of voting. And then after everybody votes, then we can have a conversation, because then you can't change your vote. And that's a simple example, but I could see the same thing being useful when an executive committee gets together to discuss how they should act in response to some outside crisis or something like that. Getting the votes before the conversation would be
Right.
really good.
And it's not a decision making vote. It's a vote to stimulate the conversation.
Right.
That's really the key, right? To see whether there are different points of view, so that you have a much more robust conversation or debate about a project or about a ranking of initiatives, etc.
Yeah, no, that's really good. So to go on to a completely different topic, these days artificial intelligence is sort of all the rage. And when we spoke recently, you had some really good insights on different layers of insights, really, on artificial intelligence. Can you share with us how you see it affecting businesses?
Sure. I think you need to, once again, from a valuation, value creation perspective, there's a couple of, we need to split it up into sort of different uses, if you will, right? Or different types of companies. The vast majority of companies are going to be users of artificial intelligence, right? They're going to use artificial intelligence to improve customer service, to improve their product, to improve their costs, to make processes more efficient, those kind of things, right? So it's really, artificial intelligence is really just like any other improvement tool, right? It's not any different than that. So it's always a question of how does it translate into cash flows, either through higher revenues, lower costs, et cetera, right? Important thing to keep in mind, though, is that in many cases, your competitors are doing the same things that you're doing, right? So for many companies, using artificial intelligence to improve revenues or reduce costs is going to be just the price of doing business, right? Because your competitors are doing the same thing. People are not going to buy more clothes or groceries in total, right? Because of artificial intelligence, right? They may, be happier with their choices, with the buying experience, et cetera. But they're not going to buy more because competition is going to, keep things the way they are. And so the question is, can I gain a competitive edge, or do I just need to do this to maintain my position, right? And how much of it can we capture, or can I capture, versus how much is going to be returned to the consumer? It's great for the economy, and the consumer, even if it's not good for the companies. But that's the case with most innovation. A lot of innovation, the value ultimately goes to the consumer. Right? The second thing are the companies that provide services to the AI industry, right? The people who operate data centers, the people who sell air conditioning equipment, the people who sell electricity, right? Once again, it's a simple translation into cash flows, right? They're going to generate more revenues. If they have a competitive advantage, that'll come at an attractive return on capital, and they'll create value that way. So once again, no difference, right? Then there are the AI companies themselves, the ones who are providing the AI. We're starting, and that's still in its infancy. So, but once again, it's going to be a lot of the companies have subscription models, for example. But it ultimately is going to boil down to what kind of cash flows can you generate. So how much are businesses and consumers willing to spend on AI, and how much competition is there going to be that'll keep prices in a reasonable range where AI companies earn enough to invest and continue to improve their products, but not, will it be competitive so that their returns are attractive but not exorbitant? We don't know yet how that's going to play out. We don't know yet how generalized AI tools are going to fare relative to more specialized ones. And there's a big debate about that, right? So I don't know the answer to that, but I know what kind of question, I think what kind of questions to ask, right? is, sort of what's the revenue model and how competitive is the industry going to be. And then there's a
Hmm.
fourth element was, can I use AI to help me do better job assessing the value of a business or to come up with strategies. Once again, that's still there's some simple things that you can do right now with AI.
Hmm.
You can gather and assemble and summarize information about a company much more quickly, but you're not at the point yet where it can help you predict what direction things are going, right? We're working, for example, on trying to see if you can define competitive advantages using AI. And the better you can define it, the more you can assess how sustainable that competitive advantage is, right? But in terms of predicting inflection points in industry growth or trends or new ideas, I think the jury's still out as to when and if it will be able to start doing those kinds of things. And so, for example, in the beer industry, there's been a shift away from beer to alcoholic seltzers, ciders, and other things like that. General lower consumption of alcoholic beverages, at least in the U.S. I don't know if the AI could have predicted it, or
Hmm.
will be able to predict those kinds of shifts, or maybe it just does a bet. Will do a better job of when something does get invented, or a trend does start, of figuring out how quickly that trend will follow. But we don't know yet, how that's going to play out. So right now, it's
Hmm.
helping more with efficiency as opposed to sort of true insight about the future.
Hmm. Hmm. Yeah, which of course raises the question of how intelligent the artificial intelligence is, right? Because it's come so far in recent years, but it's still so far away from natural intelligence.
Right. And
Which is
there's a
kind
big debate about how far it can go or when it will come when it will be there.
of,
Certainly, there are going to be some applications that are specialized applications like medical diagnosis, where you can imagine it's going to make a really big difference, right?
yeah, yeah, yeah.
Maybe customer service and things like that. But then there are others that we just don't know yet.
Hmm. Hmm. Yeah. You said a couple of things there. I just want to come back to. You said in a very small part of your answer to that question, if you have competitive advantages and you earn an attractive return. I know we think alike on this, that you don't have attractive returns unless you have competitive advantages. Otherwise,
Yes.
competition just competes them away. I don't know how you feel about this. I'm amazed how often I meet, maybe less so CEOs, but CFOs that don't see that the linkage as plainly. And so, therefore, some of the things they're inclined to do might be short-term cost cutting, but that's going to maybe moderate some competitive advantage, and the net effect of it's going to be less value, not more value.
Right.
But the
Right.
cost cutting is so attractive, they never assume anything's going to happen to demand or pricing or anything like that, which is so driven by competitive advantages. That I don't know. Do you have any comment on that?
I think you're absolutely right. Actually, I was talking to an investor. He's runs a long only fund. I think they've got 40 or so $billion under management. Very sophisticated, do a lot of deep research. And when he meets with executives, CEOs, CFOs, that's one of the questions that they ask. They sort of word it, how do you make money, right?
Hmm.
Which is really a way of saying, what's your competitive advantage, right? And how
Yeah.
does that translate into and if they can't answer that question, then he's not going to invest, right?
Hmm.
And, we're surprised at how often people can't answer that question. Or if you
Hmm.
ask 10 executives in the same company what their competitive advantage or advantages are, you'll get at least three or four different answers, right?
Yeah. Yeah.
Or they'll be vaguely defined. Too
Hmm.
often, the competitive advantage is vaguely defined when you push on it, particularly things like synergies across business units, right?
Hmm.
You find that they can't come up with any concrete examples, right?
Hmm.
So I do think that defining that competitive advantage and translating it into return on capital is something that people just don't make that linkage, right? And
Hmm.
as a
Hmm.
result, you're right, CFOs resort to simple things like cost cutting, right? Or saying, we're going to increase our profits faster than our revenues, or every business has to generate a certain amount of cash flow relative to their profits, regardless of effectively how fast it's growing, right? And as a
Mm-hmm, mm-hmm,
result, you've seen a number of companies that once were considered innovative that are no longer innovative because they've sort of, in order to get that nice earnings stream, they've cut back on the investments in innovation, right? You
mm-hmm,
see companies that are breaking up so the businesses can grow faster. Well, it's like, well, why do you need to break up to grow your businesses faster, right? You're the CEO. You've been holding them back. That means, right? So you do see a lot of that out there, and it's a big opportunity for large companies
mm-hmm,
and for the shareholders to create more value if companies would be much more thoughtful about defining the strategy more precisely, defining the competitive advantage more precisely, and translating that into the both the return on capital and the long-term revenue growth to the organic revenue growth,
mm-hmm.
and therefore not taking short-term decisions that are going to get in the way of maintaining that competitive advantage.
Yep. Very well said. So when we spoke recently, you said something, and I have a quote here, which I want you to sort of explain. But you said, this is probably pretty close to exactly what you said. When we were young, we talked about management, and now we talk more about leadership, but we still need management. It's a great statement. Can you explain what you mean by that to the audience?
Yeah, I think there is a distinction between what people think of as management is about making decisions, right?
Mm-hmm,
Specific decisions and setting targets and stuff like that at every level of the company, right? I would define, the way leadership seems to have evolved over the decades that you and I have been in business, right?
mm-hmm,
It became much more fashionable because it sounds more like, okay, I want to inspire people. I want to, be a person who, everybody gets excited because, we're I'll go back to the word, I'm inspiring kind of thing, or I lead by example or whatever. But someone's got to still make the decisions, right?
mm-hmm,
And that's my concern. So if you look at business schools, right, uh, the the language that they use emphasize, we graduate leaders, not managers, right?
mm-hmm, mm-hmm.
And I'm not saying you shouldn't develop leadership skill. Leadership skills are very important, but to have a CEO who's a great leader but not a good manager is probably not sufficient because they're not going to be able to make the tough decisions that need to be made. They're not going to be analytical enough to know what those decisions are. And so I think the language is an issue. And I
Mm-hmm.
think that maybe we should hyphenate it, leader managers or manager leaders or whatever. But we
Yeah.
need both,
Yeah.
not just leaders.
Yeah, no, I think that's really good. And just you talked earlier about it doesn't always have to be a consensus. I think that's been one of the problems I've seen with resource allocation.
Mhm.
One of my clients a few years back, we did some top-down work with the finance and strategy people to come up with an alternative plan that reallocated a lot more money toward the businesses that were creating more value. And the numbers were really big. And the CEO decided he wanted us to present it to the executive committee and then allow each segment and their business units to go back and do a replan. And in the end, by getting everybody involved in it, they only reallocated about half as much as we did.
Mhm.
And I mean, it was billions of dollars of MPV that evaporated, because of wanting to get everybody to be part of the process. I think that would have been, in that particular case, it would have been better to tell people how you're changing their resource allocation rather than, asking them to consider this and do a replan. I think that, yeah, the idea that you need to be not just, you do need to be a leader. Leadership is important. And I'm glad you talked about it. That hyphenated way of describing it is good. But you're right. You also have to be a manager. You have to be able to make a decision.
Right. I had one situation where everybody agreed in principle on the resource allocation, but it wasn't happening. And so the CEO said, I want a dashboard or a cockpit so I can see whether or not we are actually reallocating the resources.
Hmm,
I
hmm,
want to measure how much we're moving the resources from the older, less businesses with less opportunities to the newer businesses,
hmm.
um, so that I can monitor it on a quarterly basis because it just wasn't happening, right? Even
Yeah.
though everyone agreed in principle, right? So
Hmm,
you need tools. You need in this case, it was, the CEO is the one who had to make it happen. It just wasn't
Mhm.
happening otherwise, as in your case.
Yeah, yeah, this is great. Is there anything else you'd like to add before we close?
No, thank you for having me. I just wanted to say that I think that in the course of my career, like I said, we've made a lot of progress on getting people to think about the drivers of cash flow and how they create value. But there's a big opportunity still for larger companies, in particular, to be more long term oriented and to reallocate resources along their along the lines of their strategy. There's too much of a disconnect that gets in the way. There's a whole bunch of causes that we talked about earlier that you
Hmm.
need to sort of be systematic about diagnosing why aren't we investing in our strategic initiatives. And it doesn't have, some companies say, oh, this is too hard to do, right? Well, you start out small. You start with the quick wins, right? What
Hmm.
kinds of things can I do to move in the right direction, and eventually you get better at it, right?
Hmm. Hmm.
But you don't just throw up your hands and say, "Oh, we'll never be able to do this."
Yeah, yeah. I think I've seen that a lot. But well, we've been speaking with Tim Koller. Thank you, Tim, for joining us. This has been a great conversation, and I really appreciate you coming on.
Thank you for having me. I really enjoyed it.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.